Back when the pandemic wasn't even a thing, Timothy Springer understood the danger of the viruses and the damage they could cause. So a decade ago, when he came across the biotech company in the Massachusetts called Moderna, he decided to invest in it. The company focused on the developing drugs to finding the new methods to create vaccines. It wasn't the existence as electric cars or the online shoppings, but as the biology professor. He understood the importance of the vaccines, so when the pandemic hit the world, the vaccinations of the Moderna skyrocketed, and his 3.5% stakes in the company now equals to $2.1 billion. That is probably one of the best investments ever. But how do you find such companies way before they get popular? How do you find investments that can turn you into the billionaire? One book can help us to answer these questions. Is the intelligent investor. In fact, Warren Buffett has said multiple times that his books had the biggest impact on his investment philosophy. By applying the rules and the principles of the intelligent investors, Warren Buffett went from the nothing to $90 billion. So let's find out the five most important lessons out of his book. Discover patterns. Before you buy a single stocks or throw a dime into the stocks market, it's not enough to look at the stock's history. What's more important is to look at the history of the stocks market itself. No matter how great the certain company is, every stock is driven by the regular stocks market ups and downs. Amazon has clearly been one of the greatest companies out there, but in the 2000s, when the dot-com bubble burst, Amazon stock's price fell from the $107 to a little less $7 in the less than 2 years. Even if you have made your fundamental analysis and purchased the Amazon stocks, you would have lost 90% of your investments in just 2 years. But if you had understood stock market's overall history, you could have predicted the crash, as many other professional investors did, and could have saved a fortune. Of course, Amazon got back on its knees and turned into the to be widely successful, but most companies didn't. In 2008, the exact same thing happened with the mortgage securities. At the end of the 2017, cryptocurrencies had their astronomical rises and the dramatic dip. In fact, we made an entire video warning everyone not to invest in the peak and wait until prices crash. As all intelligent investors, you should not speculate but rather understand the stock market history and discover patterns to find out what is the best time to invest. Second, choose the investment strategy that fits you. Apple is one of the companies that made a lot of the investors millionaires and even billionaires. But if you would have invested in the $1,000 in Apple in June 2008, how much do you think you would made by January 2009? Negative 50%. If you weren't risk tolerant, you would have sold your stakes afraid you might lose more. If you do not exist but if you have keep it, it would have increased by the 3,600% by December 2020. Economic crashes like the 2008 in the 1929 are the fact of the life that happened time from time. Those who need to ensure that you can take the big hit and survive, this means that you should have the diversified stocks portfolio so your investments don't all get hit at once. If you are too emotional, then consider investing in low risk securities such as the government bonds or ETFs. If you think you can handle stocks market daily ups and downs, then you might be able to slightly higher risks to invest in the tech companies, for example. Once you have found the stocks that you are determined to be safe and sound, you will want to set your investments on autopilot. Start by committing yourself to a certain amount of the money, like 50, which you will invest every month. Third, don't trust the crowd or the market. If the stock market was a human, he would be the most emotional person on the planet. Let's call him Mr. Market. Mr. Market is easily influenced, and this causes him to have the major mood swings. You can see this in the practical in the way the market always swings back and forth between the unsustainable optimism to unjustified pessimism. As a result, when the market is too optimistic about the future growth, stocks price rise and become too expensive. On the other hand, sometimes the market is too pessimistic about the future, like it was in the February to 2020, and might push you to sell at the wrong time, forcing you to make significant losses. When Apple came out with the iPhone XR, a lot of the people were unsatisfied with this phone, so the stock's price dropped. But a few months later, when the Apple reported good revenue for the quarter, the stock's price jumped back. In fact, it has grown significantly since then. As the intelligent investors, you need to be realistic and stop yourself from the following the crowd and ignore the mood swings of the Mr. Market. The market normally understands the stocks of the companies which are either temporarily unpopular or are suffering economic losses. Berkshire Hathaway stock's price dropped by 30% in February, like the rest of the market, but didn't recover instantly like the rest because it has huge stakes in airlines. But once it sold its airline stocks and made a few other good investments and reported good profits by September, the stock's price jumped back. If you would have trusted the crowd, you probably have avoided Berkshire Hathaway. But if you were intelligent investors, you would have jumped in and invested. In fact, I invested in Berkshire back then and posted on my Patreon why investing in the Berkshire back then was the good investments, and those who are listening to my advice made a lot of money. In fact, I also predicted the Disney's stocks would significantly rise, and I listened all the reasons why that will happen on my Patreon back in the September. I guess is that what happened a few months later. The stock's price rose by 33% for the exact reasons that I have told my patrons. If you wait to join my Patreon page to be the first to know about the future investments, you will find the link in the description. Fourth, it's easy to assume that investing is complicated than when it looked at all this complicated charge. But investing at its essential is simple. You have to find out the value of the certain company and compare it to the price that it's trade in the market. If its trade is a lower price than the good investment since it's undervalued, and if it's higher, then it's the bad investment since the stocks is overvalued because at some point in the future the price will rise or drop in the real value. The challenge is to learn to analyze the stocks. For example, there is the price to earnings ratio, which we have covered in the previous video. How much you will be paying for the each dollars that the company earns if you buy the stocks, or price to book ratio to compare a firm's market capitalizations to its book value, to find out how much the company is going to earn for it sold all its assets and paid its debts, or debts to equity ratio to find out what degree of the company is financial its operation through debts versus its own funds. If the company is debt-free, then it's not taking full advantage of its resources. Tesla, for example, has the technology to build electric cars, but it can only build a limited number of the cars since it has only a certain amount of the cash. But it can borrow money at a very low rate of 2 or 3% and have rate of return to 10 or 15%. And that borrowed money by building the 7 more cars. So if it's not dying that it's clearly missing the opportunity. But there is just so much demand in the market, so if they borrows too much, it might not be able to sell enough cars to make interest payments and might default on its loan. But it's not enough to look at the financial statements. The management that runs the economy is equally important. how the economy is planning to double or triple its value. It's one of the factors you should be looking at. So before buying a stocks, you have to analyze it from top to bottom. Number five, know when to exit. The nature of any businesses is to rise and fall. Even Jeff Bezos said that experts Amazon one day to fall. The world is constantly changing. Just because a certain company has dominated in the industry today doesn't mean it's going to stay there forever. So you have to know where to sell your stocks. Should you sell just because the stocks increased 10 or 20%? Should you exit and realize your gains? Not really. As soon as you realize that one of the companies in your portfolio is overrated and its stock's price is growing without any relations to its true value, then it's better to sell it before it crashes. Warren Buffett invested $500 million in PetroChina when it had an overvaluation of the $30 billion and wasn't popular yet. The stock's price surged a few years later when oil prices rose. First, it crossed $100 billion, then 200, and then 300, and crossed the trillion-dollar valuations. But Warren Buffett sold its stakes when the company was crossed the valuation of the $275 billion. Many have criticized him for the selling too early, but Warren Buffett did the right thing. Since the stock's price was raising for the no strict reasons, it was overvalued and would crash at any moment. And like every other investor, Warren Buffett didn't know when that chaos will happen, and so he sold his stake. The stock price, of course, crashed once it crossed the trillion-dollar market, and it's now traded at just $112 billion. You don't have to follow each of your stocks every single day, but you have to keep in mind that whatever one of the companies you have invested in dramatically rises or not real reasons, then it's better to sell before it crashes. And finally, if you want to start investing within 4 free stocks, you can do that by just signing up to the by using the link in the descriptions and depositing $100. Second of these stocks can be valued as much as $160, considering it as your Christmas gift. And now it's the time to give this a thumbs up. And if you're new around want to know more about the stocks market, then hit the subscribe button and the bell beside it. And if you want to know more about my investments, then check out my Patreon page. Thanks for watching, and until next time.